The first trading day of this new year was nothing short of volatile. We had most of our major index markets on their most conservative volatility models. We had other markets displaying signs of volatility as well, and we had plenty of volatility trade setups today. In today's video, we're going to review all 10 of our major futures markets, so this will be a bit of a longer video. I'll leave timestamps for those of you that would like to skip around, but in this video, my goal is to review all 10 of these markets and the different trade setups that we had to really help paint a picture of the volatility that we had to start off this new year, the very first trading day. Now, to get started, we can use our morning volatility note to gather our volatility bearings. This morning volatility note is an email that we send out to all of our futures Volatility Box members. We send this out at 7:25 a.m. Pacific, so about an hour after the market opens. And this note contains our volatility landscape for the day. We take a look at all 10 of these major future markets, and we rank the volatility that we're seeing inside of these markets by determining which volatility model we're going to use. So you'll notice here we have things like the S&P 500 futures, the NASDAQ futures, the Russell futures, and all three of these futures markets at 7:25 a.m. Pacific were on their doomsday conservative volatility models. Now, to make sense of all of these words, doomsday conservative, conservative, aggressive, we can take a look at the scale that we see down here inside of the morning note. This gives us a ranking mechanism for the 5 different volatility models that we have. So at the most aggressive end of the spectrum, we have our scalper volatility box models. These are most used for things like scalping opportunities. The risk rewards are smaller, but we're looking to get in and out very quickly. Today, these 3 markets were on their doomsday conservative models. That's on the very opposite end of the spectrum. Aggressive is 2, doomsday aggressive is 3, conservative is 4, and finally, doomsday conservative is 5. So that gives you an idea that the S&P, NASDAQ, Russell, very volatile today. We had to adjust down to our doomsday conservative models to try and trade this volatility and take advantage of it. The Dow was a little bit less volatile, number 4 at conservative. The 30-year note started on its aggressive model, that's number 2, so a little bit less volatile to start off the day, and by the end of the day, even the 30-year note had caught up to the doomsday conservative model, so caught up to number 5. Now, inside of crude, natural gas, and copper, all 3 of these models were on the aggressive to start off with, and we had some interesting trade setups, which we'll discuss. Gold was on its aggressive to start off the morning, and silver was on its scalper. So between these 2 markets, the 2 metals, gold was a little bit more volatile in comparison to the silver, where we could still be looking for scalping opportunities. Now, I'll leave a video that breaks down the setup that we're looking for with all of these models in the description box below. I'd recommend watching that before you move on with this video. It will really help to break down the setup we're looking for, which was exactly what I'll be discussing for all 10 of these futures markets. Now, let's take a look at the results, and you can use the timestamps in the description box to skip around based off of what you're curious about. With the index markets, we had no trade opportunities, all 4 index markets, and same thing with natural gas. So no trades there, but we'll review the charts. After that, we'll take a look at gold. Inside of gold, 2 different trade setups, one short, which was a winner, one long, which was a winner. We'll contrast that with silver, where we had 2 long setups there. Both were winners. The first one was the more interesting setup. The second one came with that very weird, awkward gap that we had in the markets today in the morning. Now, after we take a look at gold and silver, we'll move on next to copper. Copper, we had 1 long trade setup, and copper was a loser. We'll contrast this with crude, very similar setup there, and inside of crude, that setup was a winner. So hopefully that helps to give you an idea of how those markets move in tandem as well with the different setups same time. Finally, we'll take a look at the 30-year note, where we had 1 long trade setup, and that trade setup was a winner as well, but a little bit less interesting setup there. No real runners, just a very quick T1, and that was it. Now, make sure to use the timestamps to skip around. Again, as I mentioned, this will be a longer video, but my goal is to try and cover each market for those of you that are Futures Volatility Box members and give you a breakdown of what I'm looking at. All right, with that, let's dive into charts. We'll start by taking a look at the index markets first, and then move on to natural gas and then gold. I'm inside of my Thinkorswim platform, and we currently have a chart of the S&P 500 futures loaded on. That's ES. And I have the Doomsday Conservative models, but before we take a look at these, I'd like to start with the conservative model so you can see why we chose the Doomsday Conservative in the first place. So starting off with the conservative here, actually, if we start at the very beginning, and we'll do this just for the S&P, we start with the scalper. That's what we start with every single morning, and I detail this in our 10-minute volatility process. It's very easy. You start with the scalper and you make your way up based off of what the market is telling you. So in this case, we take a look at the scalper and we ask ourselves the question, hey, is the scalper doing a good job of determining the market volatility all the way up until this yellow line right here? That's 7 a.m. Pacific, 30 minutes after the market opens, and we really have this first full hour's worth of activity to make that decision. Now in the case of the S&P here, we can see it does not. Price very clearly breaks outside of these clouds. So we say, hey, scalper's not doing a good job. We move on to aggressive. So on the aggressive models, we take a look, same thing. We've broken outside of the clouds before we even have any capital at risk. That tells us the aggressive model's not doing a good job as well either. We move on next, Doomsday Conservative models. We breach. The question is, do we hold? If we extrapolate this, we don't hold. Instead of seeing this move with buyers stepping in, we instead see sellers stepping in, bringing price action down lower. So again, the Doomsday Conservative models not doing a good job either. That takes us finally to the conservative models. There's same idea, we breach but don't see buyers, and that's how we land up on the Doomsday Conservative models. No breacher, we have volatility that's a little bit more contained. Now we're looking to see if sellers can push down to levels like the cyan line throughout the day, and that's where we finally have a volatility edge. So inside of the S&P, we were on these Doomsday Conservative models, and throughout the day here, if I zoom out, you'll see none of these cyan lines on both sides were breached. That volatility was in the morning, and then for the rest of the day, it almost started to lower down, almost muted down to a point where we didn't really have many interesting trade setups. Same idea inside of the NASDAQ. If we take a look, very similar idea the rest of the day, just chopped in between sideways. And if we take a look at the Russell, same thing as well, although the Russell here did breach our cyan lines down here. We even had the edge signal confirmation, but we never actually got the retest that we were looking for. So it ended up being a winner without us, didn't meet our rules to the point of giving us an entry where we actually had an edge. So the Russell, though, should help demonstrate the idea of what we're looking for and why we continue sticking to the models that the morning volatility tells us. Now, we take a look at the Dow here. That one was on the conservative Volatility Box models to begin the morning. There we had breached our conservative models, but unlike the S&P and the NASDAQ, instead of seeing that sell-off, we instead saw buyers come in and buy these levels, taking us to what would have been our first target. That's this distance right here, extrapolated on the other side. We hit that first target, which told us that, hey, buyers have enough strength here inside of the Dow where we can still continue to buy any dips off of the conservative Volatility Box models, which just still weren't breached for the rest of the day. This is also that weird gap that I was talking about earlier. We had this take place. I'm not sure if many of you saw this as well, if this is just on my charts. I have not yet confirmed it on other platforms, but definitely a little weird to see, especially on futures markets and even the liquid ones like the S&P, which you just don't see gaps on. So anyways, those were the 4 major index markets. We can also take a look at the natural gas futures, which were on the aggressive models. No breaches there either. So the first 5 markets we took a look at, we understood volatility. We got a better sense of our volatility models. We understood how to determine the volatility models based off of the morning process, but we have yet to see a trade which meets our rules. So now let's move on next to gold, where we can see an example of just that. So I'll switch to GC futures. GC futures, same thing. Let's start from the beginning. We send the note out at 7:25. By that point here, we had already broken outside of the scalper models on gold inside of that first 6 to 7 a.m. Pacific hour. So that takes us to the aggressive volatility box models. The aggressive volatility box models do a much better job of containing volatility. And there we had the short setup with price action breaching the upper edge of the volatility box models. That was step number 1. We had the edge signal confirmation, which tells us that, hey, we're officially now in overbought territory. The entry is at the cyan line or better. Our risk is outside of the volatility box clouds. That's where our stop is. And our first target is that same distance which inside of gold on this first trade was 3.3 points. That's again the distance from the cyan line to the outer edge of the clouds, and hopefully you can see that through the clouds there, 3.3. Now, beyond that, once we hit the first target, we move our stop to break even, and our second target is this gray target line right here that you see on the other side of the chart extrapolated. And in the case of gold, that was 8 points. So this was the first short side trade opportunity. We hit T1 and T2, and that T2 went so much further that we breached the other side's long volatility box model entry as well. So we're still on the aggressive. Now here we're waiting for the edge signal. The edge signal doesn't come until after we break outside of the clouds. So we switch from the aggressive. We're now adapting to volatility. We go to our next model, which does a much better job of containing volatility. We get the edge signal. You have an opportunity to enter at a price much better than the cyan line, but I still use the cyan line for the sake of the calculation for this video. And this was a risk of 5.3 points. And if you were able to get the entry at the cloud, you shrunk that down to about 2.7 points. So it gives you an idea of the two different ones, but I'm still using the entry at the cyan line. This is the 5.3 points. And we're looking for that for our first target as well, 5.3, extrapolated on the other side, and same thing for the second target as well, which in this case we hit. So gold was a nice example, two different trade setups, one short, one long, and in both of these trade setups, we had nice follow through in which we had a very nice systematic set of rules that got us into the trade, that kept us in the trade, and that allowed you to try and ride out a lot of this position. Again, though, very weird gap here that you keep seeing across the board, which I was just very confused by. I'm not sure what happened there. Now that we've seen gold, we can move on next to silver, where we can contrast this volatility. Inside of silver, we started with our scalper volatility box model, so that was a 725, and in that same hour, we continued to break outside of our volatility box clouds. So now we're adjusting to volatility. Aggressive volatility box models is next in line, and using the aggressive models, we hit our cyan entry line. We get the edge signal confirmation. This tells us we're officially in oversold territory here. And we get the green arrow. We have an opportunity to enter at the cyan line or better. Our risk is outside of the volatility box clouds. In the case of silver, that was about 85-ish points. And we made that same move on the opposite side all the way up to about 130 points inside of silver. The second long entry that I talked about, which came in the subsequent hour, was this one right here. And there, we didn't really have an opportunity to enter based off of our rules, but we did get the breach and we did get the bounce, but that was again off of this very weird gap, which I'm choosing to ignore for the sake of any kind of useful information from this particular trade in silver. So those were the two different opportunities inside of silver. Now we move on next to copper. So if we take a look at copper off of the aggressive volatility box models here, copper, we had a long side setup very similar to the silver one. With this gap, we had our long models breached. We breached our cyan entry lines. We had our edge signal confirmation, again, our oversold trigger. This tells us we're expecting copper to now start to chop around sideways and then bounce up from here. And instead of that, copper continued to drift down lower, and this ended up hitting our stop. And it wasn't one of those where you hit your stop and then very quickly reverse, but you hit your stop, you bounce back up just a little bit to still continue to dip down lower. So it wasn't a stop that made you feel too terrible there. It was a stop that was worth taking. It was just a trade that didn't work out in our favor. So that's copper, but now let's go ahead and contrast this with crude oil. So if I load in CL next, CL, same time period, is when our trade setup came. We were on the aggressive models here. You can see price action goes outside of the clouds before we get the edge signal. We adapt to volatility. We know aggressive, no longer doing a good job of containing volatility. We switch over to the doomsday conservative. Same thing, went outside of the clouds before the edge signal. And that takes us to the conservative, which was the model that finally held. Same idea though, same setup, breach the cyan line. We get the edge signal confirmation. We look for a retest of the cyan line. We get that. Stop is outside of our volatility box clouds. This is the amount that we risk, and that's what we're looking for as our first target as well. And second target, gray target line, nowhere near getting reached today inside of crude. So helps to contrast gold with crude oil here, where we hit only T1 and then all remaining contracts taken out at break even when price action reverses. So that's crude here, helps to contrast an idea. And the other thing in crude that I thought was somewhat interesting is if you zoom out, Really, this was just a bear flag in what was otherwise a pretty clean downtrend where we just came back, we retested the lows from the morning, and that's where price action from where we were looking to enter ended up going until before it reversed. So somewhat of an interesting observation there. No real huge move inside of any of the energies, crude or copper. Now finally, we have the 30-year, that's ZB futures. We'll start with the aggressive models here. Same idea, price action breaches the cyan entry line. We had the edge signal. We ended up making a move to exactly the 5 ticks, but this is where this trade, if you say had slightly worse of an entry point, this trade was a loser, not a winner. So that's one thing to call out inside of this 30-year note. However, after we hit that very quickly, if you didn't get out, this hit your stop, and that stop then takes us from the aggressive to the doomsday aggressive volatility box models. This doesn't do a good job of containing volatility either. And if we continue adapting to volatility, we go all the way to the doomsday conservative models, which are the ones where price action was contained, we had price respected, and these were the same models that the S&P, the NASDAQ, and the Russell were, thanks to the volatility we saw early on in the morning. All right, so one more time, I hope you connected the dots now. If we come back to our morning volatility note, hopefully this helps to make a little bit more sense with where we started off the morning compared to where we ended up with, and how this entire ranking system right down here comes into play when we determine which volatility models we use, how we use these different volatility models to trade at the edge, and how we take a look at all of these different futures markets to try and find the markets where we have the different trade opportunities working in our favor. All right, take care everyone, good luck trading, and I'll see you in the next update.